Matt Miller.
U.S. stocks posting their biggest decline since the Brexit vote, all major indexes losing at least 2%.
But the question is, what'd you miss?
The complacency in global markets getting upended as central banks start to question the benefits of further monetary easing.
Plus, that's causing a whirlwind in the markets, sending government debt, stocks, and emerging market assets to the biggest declines since June.
And in auto news, Ford is buying into the ride-sharing game, but record profits and strong sales aren't helping lift the stock as we see a decline coming forward. My interview with CEO Mark Fields later this hour.
We begin with our market minutes. And, Matt, looking at the S&P 500, the biggest sell-off since June 24th, the S&P 500 down 2.4%. The Dow Industrial is losing 392 points. We were in this summer stupor where nothing really moved, and there was this calm. We talked about the VIX sinking to fresh lows constantly. All that is gone at the end of this week.
Red across the board, across all the major indices. Fine, we were talking about that streak of no gains or losses of 1%. That getting erased in a very big way.
But you know what? During those last 40-odd days of no huge swings in either direction, we rarely saw the IMAP all one color. And at the beginning of the year, that was pretty constant. Take a look at my IMAP here. This shows the S&P moves broken down by industry. And as you can see, red across the board. Joe said it. I'm showing it to you right now. The big losers, the big stocks were big losers. So Apple, telephone, Amazon, all losing, and of course they are so big that they drag the index down. I just pulled up a chart of the VIX here, and what I think is interesting is that the VIX just continue to climb throughout the day. When I looked at this a half hour ago, we weren't up through the 200-day moving average on the VIX. This is a one-year chart, but we've now shot up through that. So a gain on the VIX of, let's see, 4.8 points, a gain of 40% in a single day on the VIX.
So the big story, right, going on is the backup in interest rates, particularly at the long end of government bond curves all around the world. So I want to do an extended look today because that is the story. Let's just start simple in the U.S. You see the tick higher, you see higher across the board, but the real action at the longer end of the curve, some bear steepening with treasuries down, yields up, yields higher, particularly at the long end. Now let's look at the spread. You can see it, the spread getting significantly wider in the last several days. For so long, we talked about the declining spread, and would it invert? Well, we've seen an erase of that. Right now, we're seeing some steepening. Let's go over to Germany and take a look at the German 10-year over the last month. We're in positive territory. German 10-year yield actually yielding something, 0.01%. Extraordinary. Of course, we had that ECB meeting yesterday. No hints of an expansion of QE, so maybe some disappointment there. Investors are expecting more bond buying. I want to put that into perspective, though, because here's a one-year chart of the German 10-year, still incredibly low by the standards of this year, but up significantly from where we were in July when we were significantly lower. Finally, I want to take a look at a one-year chart of Japanese 10-year yields. Ooh. We've seen a really big backup in rates there. Again, similar story, expectations that the BOJ might not continue its bond buying program. We also saw it bottom around the same time. So this is the defining story in markets right now. It's the tail wagging the dog, or whatever you want to call it. And this, given the all the assets and the chase for yield and the idea that you would buy equities based on low yields, any sign of a sustained backup in rates is going to have these ripple effects.
And we have that banner that says long-dated bonds lead global sell-off. It's JGBs that are leading the global bonds.
It's JGBs, then Germany, now the U.S., and now everywhere else.
And, of course, we'll have Matt Bozer join us in a few minutes to break it all down. Meantime, when stocks and bonds decline, the dollar, it's doing well right now. That's what we're seeing today. The Bloomberg Dollar Index ending the week with some strength. For the week, it's back to where it was around Monday when the U.S. was closed, but the rest of the world was trading. As for specific pairs, I'm looking at the Aussie dollar. It lost as much as 1.3%, the most since the days after the Brexit vote, like most of this asset classes that we're looking at. You did have data this week that showed a drop in home loan approvals, which suggests that confidence in the housing market is cooling, and that would allow the Reserve Bank of Australia to lower rates in the future without sparking another housing boom. So that perhaps might be a factor as well. emerging market currencies are in retreat. I'm looking in particular at the Latin American pairs, the Mexican peso, the Brazilian real, the the Colombian peso. And of course, the increase in U.S. yields undermines the risk-carry trade of borrowing dollars to purchase these higher-yielding emerging market assets.
Finally, let's take a look at commodities, because the story is everything is down, and that includes commodities. Crude oil down over nearly 3.7%. Silver getting smoked, down nearly 3%. And gold also losing a little bit less, not surprisingly, because gold has safe haven characteristics, so it's losing the least. But it's such a broad-based sell-off that even what you'd expect to, the safe haven is down as well.
All right, those are today's market minutes. It was a lot more than just a few minutes, but we want to take a deep dive now into the Bloomberg. You can find all the charts using the function at the bottom of the screen.
So I'm going to show you something that you've seen from Joe in the past. You've seen it from Oliver Rennick as well, but it's really pronounced here. The unraveling of the bond trade, and what you're also really seeing is consumer staples, utility stocks, defensive sectors coming down. The interesting thing is that now they're coming down at the same time as yields are going up, and previously yields and these industries had been positively correlated, even, during the Brexit and post-Brexit. So you saw stocks rising as you saw bonds falling in consumer staples, in the utilities sector. Now that correlation has not only come down, but actually turned negative.
So all the things that people thought were safe and bond-like not holding up in this market.
And of course, as we mentioned, Japan kind of leading the way here for this bond sell-off. The yield curve is steepening, not just in Japan, but in the U.S. and Germany as well. That is a good thing for banks. So here's Japan's yield curve. It's the white line, and here we're looking at the spread between the 2 and the 40-year bond. The blue line there is the Japanese bank's sub-index. It's gained about 27% over the past 2 months. And this firming is giving rise to hopes that banks may be able to borrow cheaply and lend at higher rates, boosting their profits, their margins. The shape of the yield curve is shifting, right? Because you've got yields on shorter dated bills still stuck below zero. And that's an important distinction. Andy Mukherjee of Bloomberg Gadfly points out if the entire curve jumped higher, that would actually cause mark-to-market losses on the bank's holdings of JGBs. That's not what we're seeing right now.
It's also worth noting, too, that financials were the best performing in the U.S. today. So banks
Even
liking
though they were
that,
down.
They were down, but they were the best. So banks liking that steeper yield curve all around the country, all around the world. On days like this, I really love the GMM function on the Bloomberg Global Macro Monitor. It's a quick way of looking in different columns of equities, currencies, sovereign bonds, CDS, commodities, everything. You can see it is a true sea of red. There is nowhere to hide. Everything is correlated.
Check debt.
Randomly, in the center of the screen, the one place was check 5-year bonds. For some reason rallied. It had something to do with the currency or inflation. I actually don't know, but it actually just goes to show how ugly today was. There was no place to hide today except this one little random green
And what's
spot.
notable, of course, is also how deep the red is.
Yeah,
the deeper
bright
the
red.
The bigger the losses, right?
So joining us now to discuss all this, Torsten Slok. He's the chief international economist at Deutsche Bank Securities. Torsten, thank you very much. So we saw long-dated bonds all around the world selling off. That seems to be the catalyst for the market anxiety across all asset classes, like I just showed. Does this have further to run, this yield back up?
In some sense, this is a reflection of fundamentals have slowly been getting better, not only in the U.S., but also in the euro area, and a little bit so also in Japan. But what we're seeing is that meanwhile fundamentals have been getting better, we've had the carry trade continue to keep yields low for a long, long time. So are we getting to this inflection point where the Fed is now saying, well, maybe we should think about hiking rates, and maybe the ECB is even indicating we don't need to extend the program quite yet, that therefore there is this conflict and the tug of war between fundamentals and the hunt for yield coming to an end now?
How much is it fundamentals and how much is it the rethink? You've had so many economists come out and say, even if the economies aren't great, that further easing or further bond buying just isn't doing the trick. And so maybe people expect to see some other approach that might not involve buying long-dated bonds. How much is that factoring into this?
Well, I think that that's an important factor. And I think also that the fact that the hunt for yield and the people basically chasing returns in asset classes, not for fundamental reasons, has been a very pronounced trade for quite some time. And I think many in the market are a bit confused whether this will continue, or should we actually go back and believe maybe the Fed is hiking rates, maybe there's actually inflation, because wages in the US are slowly grinding higher, CPI inflation, we'll get another print next week, is actually looking relatively better. So the question is this the time, is this the big moment where we will see that change, as Gunterlag talked about yesterday, where we will be leaving the regime of the carry trade and move back to talk about earnings, fundamentals, and macroeconomic variables?
And of course, as we struggle to figure that out, it's worth looking at participation as well. In the equity markets, volume in the Dow, S&P, and NASDAQ was about at least 30% more than the 20-day average. As you talk to people, your clients, other people at the bank, what are you hearing in terms of how much are people selling this sell-off today? Are they participating in it, or are they kind of standing back and watching to see whether it continues in the coming days and weeks?
I think clients and investors more broadly have a mindset of rates will never go up. So anything that moves up on a day like this is a really good buying opportunity. So in that sense, I think we need to see a much more persistent period and a much more protracted period where we actually see strong hawkish comments out of the Fed. A lot of people I've talked to today are seeing this as a buying opportunity, in particular, of course, with rates going up and becoming more attractive. But also equities dipping down here and saying, you know what, the hunt for yield will come back. So I don't think this is quite yet the regime change that we've been waiting for the last 7 years. And the Fed speak that we had from Rosengren and we've had also from Tarullo is incredibly confusing. We have on some side, no, it wasn't hawkish enough, and we'll see if at all it will be a hike in this year, but of course here in September or even in December. So at this point it looks like there is a good chance that we could come back to the hunt for yield even when this mini tantrum is over.
Can markets get so addicted to accommodation and extended QE that something like the ECB not extending their program is almost like tightening?
Oh, absolutely. That is why we've become hypersensitive to non-dovishness. In other words, just the fact that the ECB didn't extend the program yesterday was perceived as, oh, gee, they're about to hike rates. They are nowhere near hiking rates. So you're absolutely right. Yeah. The issue is that investors just don't want to be caught on the dance floor when the music stops. So they are so eager to say, I got to get off a little bit before, but is this the time? Is this the time? And so far it doesn't look like quite yet we're there, but this anxiety we're experiencing yesterday and today certainly reflects that there's a lot of people out there who are very trigger happy and ready to do something with their portfolios, even in the face of actually quite confusing Fed messages.
Right. Well, speaking of Fed messages, Lael Brainerd will be speaking on Monday, and this was kind of a last-minute addition to the Fed schedule. Will she be the one to stop the music?
Yeah, so this is a very important development. We spent quite some time figuring out how long time in advance this was planned. But the bottom line is she's actually talking on Monday, I should say, and she's one of the more dovish members. So if she starts to say maybe we should think about hiking rates, then, of course, it will be a very significant development. So her speech on Monday will definitely be something that not only fixed income investors should be watching, but also equity investors.
So this equity slide could continue, you think? I mean, we saw a 2% drop right now, but I don't think there was a lot of anxiety in the market. It didn't seem like people were freaking out or capitulating. It was very orderly.
Yeah, we haven't quite reached the level of panic yet, but I would say
if she gets hawkish.
Yeah, I would say for her on Monday it's at 1 p.m. So I would say wait for her and wait what she says. If she basically continues with the dovish line, then I think the market will go back and say, okay, the Fed is not going to hike at the earliest before December. So that means that the hunt for yield will probably come back, and people will find these levels of yields as low as there still are 10-year rates, as Joe just mentioned. They still will be attractive to some people who still think that, quote-unquote, rates will never go up in the U.S.
All right, Torsten Slok, you're going to stick with us, Chief International Economist at Deutsche Bank Securities.
Coming up, we'll have 3 charts that you need to see that show the global bond market sell-off that's roiling markets. This is Bloomberg.
What'd you miss? The story in markets this week, bond prices have been in free fall. Bloomberg's Matt Boesler has 3 charts that shows just what's going on, and Deutsche Bank's Torsten Slok, of course, is still with us. Matt, let's talk about this on a day when we saw, a steepening of the curve and interest rates increasing.
Yeah, really today and yesterday, you've seen in the 3 biggest bond markets, right, sort of in the U.S., in Japan, and in the Eurozone, we're seeing this big, upward move in rates across developed economies, really. And if you look at, if you sort of take that and you sort of weight them by GDP, well, you can see here, these are all 3 of the different sort of countries that we were just talking about. So you can see that U.S. real rates are highest since the Brexit vote. And then we have Japan, where real rates have actually been rising for a while and are now highest since March. And then in Germany, they've actually been going down. But, of course, over the last 2 days, they've spiked up a bit with the whole ECB thing going on. So it's kind of almost a global tightening of financial conditions, a little bit on the margin that we've gotten over the last 2 days.
Torsten, what does that tightening of financial conditions do to the real economy?
I think so far it's relatively modest, but it's clear that the question becomes whether this is an early sign of something changing. And are we in the phase now of the Fed actually hiking rates over the coming quarters, or is the market still right that the Fed will not be able to hike rates as they have been predicting now for quite some time?
That tightening of financial conditions, I know the Fed looks at it, but it's not one of the mandates. How much weight do they give tightening of financial conditions, Matt?
I think they give it a lot of weight, and especially now as opposed to before, where when you had an economy that was growing 4%, these fluctuations in financial markets didn't really put a dent in the growth path. But now when you're growing at 1.5% or 2%, they're a lot more important. So what we saw earlier this year with a big tightening in the U.S., that caused long-term interest rates to fall quite a bit. So you can kind of infer that there was some sort of offset that was needed there. And that's kind of the Fed's story, that they didn't raise rates as much as they were expected to, and so that sort of offset that tightening in financial conditions. It really goes to show you how sensitive they are to moves like this. It's not a big move that we've seen so far this last 2 days, but if it were to continue, that would be something they would be really worried about.
Just to add to what Matt said, I mean, if you look at the minutes of the FOMC meetings, there's just more and more focus on the financial stability, financial conditions. It's absolutely clear that the Fed is quite worried about the implications, both of them signaling rate hikes, but also the implications of potentially a more significant correction in financial markets.
10-year real rates, another chart that you have for us. Matt, what do you look at here?
Yeah, so if you put all those together, you can kind of look at, globally what's happening. Actually, this is the same chart that we were looking at. But so this is like kind of interesting, though, if you look at this, because you can see in Japan how we've had this move for a while and that's not really been sort of reflected in the U.S. and in Germany. And to some extent, what's going on here is the Bank of Japan has the biggest problem because they really don't have that rate offset that they can use anymore. They've got a flat yield curve. It's all, below zero, right? And so there's not really much they can do with interest rates. All of these programs that we've developed in the post-crisis period, like quantitative easing, like forward guidance, are really designed to reduce long-term interest rates. So if you've got a flat yield curve, that doesn't really help you much. And that's exactly why we're having these discussions about, like, is the Bank of Japan going to start tapering its, bond purchases in a few weeks? Is the ECB going to do this? And so this is like really in the U.S., we're not quite there yet, but we're getting pretty close to probably having these same kinds of conversations just because of how flat our yield curve has gotten and how close our short-term interest rate is to zero. So this is not a particularly good omen necessarily. You always hear about how the U.S. economy is so different, but the financial market aspect is really converging at the moment.
Torsten, do you see what's going on in Japan as being a potential harbinger of trouble? I mean, people have talked about that for a long time, Japanization of the global economies. But specifically what the BOJ is contemplating right now, are they in a jam? Are other central banks going to find themselves in a similar jam?
It's quite symptomatic that the BOJ is currently carrying out a comprehensive review of their own policies. In other words, what has worked, what has not worked, what might work in the future. The ECB yesterday did basically the same thing, saying we have to review our programs. So your good question is, Joe, well, does that tell us that they are actually thinking about what's working and what's not working. And therefore, in some sense, we need more tools, we need more firepower, because the risk here is that if the central bank starts signaling more that they are out of ammunition, then markets could get really worried about what the implications.
But aren't we in a completely different position? I mean, we can increase rates here. I was talking with Mark Fields this morning, the CEO of the Ford Motor Company. That's a company that's as dependent on the U.S. consumer and interest rates as any other. And he said he wasn't concerned about demand as long as the path is shallow and the interest rate increases are low.
Oh, that's so true. This is also why the key issue for the Fed is that as long as they're slow, gradual, and cautious, we should be fine, and that should be good for auto sales, it should be good for consumer loans more generally. But the problem is, if inflation does start to show up, the Fed will no longer have the luxury of being slow and gradual and cautious. So that's why watching what the inflation print does next week and watching what we're seeing on wages and on other inflation indicators actually becomes very, very important for whether the carry trade will continue.
I want to go into the Bloomberg because I have a chart that, Matt, you sent me earlier, and so I think you're looking for this one, 10-year real rate. What are we seeing here?
Right. So this is the GDP-weighted real rate. So if you put the German, the U.S., and the Japanese together, you can kind of see on a global scale.
So this is essentially the global interest rate.
Exactly.
Arguably.
And so this is, as you can see on the chart, highest since that Brexit vote. We had a big collapse after the Brexit vote, and then we've kind of been grinding sideways until the last few days. We had that big drop after the bad ISM report here in the U.S., and then the last 2 days we've had this spike up. So, you know, things have been moving in the right direction, but what I would say is that, you know, central bankers like to see, they want to see the yield curve steepening, but they want to see it steepening after economic data, right?
For the right reasons.
Exactly. They don't want to see it steepening when they come out in a press conference and all of a sudden markets start going haywire. That's like, you know, kind of steepening for the wrong reasons. And, you know, if you juxtapose that with the fact that we're getting that yield curve steepening as risky assets like stock prices are going down, that's like kind of that steepening that you don't want to see.
So, Torsten, how does the ECB, how did the BOJ, how did the Fed fold in this backup in yields as they assess their policy?
Well, this is a really tough question. I mean, you can't find a PSD economic model that tells you what happens today, what does it do to GDP, inflation, unemployment. You just have to watch and see the incoming data. So this is just, if this continues for longer, then the Fed just has another argument for staying on hold in September.
All right, Matthew Boesler of Bloomberg News, Torsten Slok of Deutsche Bank, thank you very much for this great conversation about the big story of the day. Thank you very much.
All right, coming up, we asked for your charts and you responded. We're going to show you the top Bloomberg charts from our viewers next. This is Bloomberg. What'd you miss? It is time to share your G chart. We put out the word. We asked you guys to contribute or to send us your G charts, and here they are. So my G chart is from Jeroen Blokland of Robeco, Netherlands, and what it shows is Bitcoin versus the 2-year yield. There's a correlation there. The blue line is the 2-year yield, but it's inverted. So when the line goes down, the yield is actually rising. So you can think of it as illustrating the price of the 2-year Treasury note falling. The white line is the price of Bitcoin. And so Jeroen says that the chart shows how central bank policy, namely the Fed, may be influencing Bitcoin's price movement along with every other asset class. As you know, people sometimes treat Bitcoin like gold, as a safe haven, as a shelter from uncertain Fed policy. So when the Fed got priced out after the latest disappointing jobs report, the ISM services report, gold went up, as did Bitcoin. And there you see it in the white line. Now,
it doesn't seem so crazy to me. I mean, Joe, you and Joe were explaining this to me this morning, or Joe was explaining me his theory this morning, I should say.
Joe, your theory involves China.
And I think it makes a lot of sense. I don't know why you think it's so nuts.
I mean,
it's your own theory.
No, my theory is that if there is a connection between rates and Bitcoin, that it probably has something to do with rising rates pressuring outflows of China, which people then use Bitcoin as a way of getting money out of. So if there's a connection, that would be how I'd surmise
that. Makes perfect sense.
Because Bitcoin is used prominently in China.
Yeah, exactly. And it's a popular way of getting money out. This chart comes to me from Dan Hurley of Apex Capital. It's the Tesla Solar City spread. And so basically it's the gap between where Solar City is trading now and where it would be trading now if investors assumed that the merger were a done deal.
Right.
And it's growing pretty wide. And in fact, as he points out,
so the
there's
arbitrage,
a 28% gap now between where Solar City is and what the nominal takeout value is, reflecting a lot of skepticism. You know, we have in any market sell-off, people get nervous. And of course, everything Elon is the kind of like, you know, you run hot and cold with him, so people are pretty.
On the other hand, if you buy the merger story, then you can buy Solar City and make 28%.
Yeah, exactly. Or you could get steamrolled.
Yes. All right, coming up, the S&P 500 index, global equities, and emerging market assets all tumbled at least 2% in the biggest rout since Britain voted to secede from the European Union. We'll talk more about this sell-off on this Calm Friday. This is Bloomberg.
Let's get a recap of today's market action. There was a lot of red on the screen. The Dow, the S&P, and the Nasdaq erasing 2 weeks of gains. To give you some size and scope of this sell-off, you can see there an almost 400-point loss in the Dow Industrials. All 30 members were lower. 96% of the S&P 500's members declined. And on the New York Stock Exchange, at last glance, 19 stocks fell for every one that was higher. And we basically closed at session lows. People are wondering if this sell-off, which was triggered by the backup in yields, marks a true inflection point, or whether this is just a breakout, a temporary breakout from a summer of very calm trading.
And as Torsten Slok just told us, I think a lot of it depends on what Lael Brainerd says on Monday, right? This kind of surprise schedule change to bring her out to speak.
And she's a dovish member of the Fed.
A noted dove.
A noted dove, so if she says anything hawkish, that may really gain some momentum there. All right, let's get some more insight into today's trading with Scott Wren, Senior Equity Strategist of Wells Fargo. He joins us from St. Louis. Scott, is it the Lael Brainerd news conference, or I shouldn't say news conference, speech that's scheduled on Monday that is giving investors so much reason to pause and to suspect that the Fed really is ready to raise rates?
Well, Scarlet, it seems to have taken on a life of its own, and it is odd that, Rosengren, pretty much of a dove, comes out, says some things today that people interpreted some as hawkish. Brainerd scheduled for Monday, but really, I don't think. I mean, this would be a poor job on the Fed's part of prepping the market for a Fed hike that's 1 week away. I just would find it hard to believe that they would do this bad of a job of trying to prepare the market. Now, if they're starting to prepare for December, that's one thing. But to prepare over a 2-week period for a meeting in September doesn't make a lot of sense to me.
Regardless of whether they hike in September or whether they hike in December, is this a market that still fundamentally is just at the mercy of the Fed? Is there anything else driving the show right now?
I think the market would give the Fed a rate hike here as long as they prepped for it, for instance, in December. But what the market is not prepared for is a suddenly hawkish Fed that talks about multiple interest rate hikes over a relatively short period of time. So I think, as I said, I think the Fed would give the market would give the Fed a rate hike in here if the market's prepped ahead of time. But a series of hikes, market doesn't have that priced in at all, and I don't really think it's necessary.
Well, you know what? Scarlett and I were talking to Jack Bogle today, and he pointed out that we're already at historically toppy valuations in a period when earnings are not expected to rise very much. And I'm talking about not next quarter, but the next couple of years, right? Doesn't that concern you, being bullish a market, if earnings aren't going to pick up and valuations are already toppy?
Well, Matt, we would argue that, it's taken 7 years to get back to what we would consider fair value. I mean, right now, the market, a touch higher than this, for this period of time, in our opinion, the market is at fair value, and I don't think valuations are stretched. So for me, when we look ahead, earnings growth next year probably be 5-7%, something like that, largely because energy earnings are going to be flat and GDP will be a little bit higher. But certainly, we've seen the bulk of the gains in this particular cycle, and I will tell you this: out into the middle of next year, the S&P 500 looks good to us. We've got a 2190 to 2290 range for year-end this year. We feel good about that, and some of our work suggests that we might trade a bit over the top end of that range into the middle part of next year. So I don't think this cyclical bull market's over, but certainly you would expect some volatility, some downside volatility, after we've done nothing but go straight up from the post-Brexit dip.
Scott, I'm interested in hearing your thoughts as an equity guy on the backup in yields and global bond yields. Does a continued sell-off in Japanese, German, U.S. government bonds at some point prompt a reassessment of earnings prospects for U.S. companies?
Well, I think it could, but we've really been hovering at low levels there. I think some sort of backup makes some sense to us. We've been looking for the 10-year to settle in the 1.50 to 2% range this year, so I don't think that's out of line. I don't think that'll change much next year. And so I think what you're seeing right now, and now this, don't get me wrong, I mean, this was a big move in the bond market, a big big move in the equity market. We thought the equity market could trade lower on virtually nothing, just pure noise, trade 5 or maybe even 7% lower from the highs. You know, this is a noise day. This is a day that investors can't think to themselves, at least in our opinion, that, hey, something seriously has changed here. This is a type of day where you have to say, gee, I have a plan. I need to step in here and put some money to work, whether it's technical support in the 2050 to 2060 area or some other level that you're watching. But in our opinion, sell-offs are opportunities to step in here and buy stocks because we still have some upside. The cyclical bull market is not over, at least as we look out into the middle portion of next year.
Scott, I'm looking in my terminal. The one in subsector that relatively outperformed today was banks. I'm looking at a chart of the ratio of S&P banks to the overall SPX, which has been rising. That's that white line. And the blue line, the 210 spread. So as we get that steeper curve lately, we're starting to see banks outperform. What do you think about the banks? People haven't liked them for some time, but is there an opportunity here if we do get a regime change on rates?
I think you need several things going on. I think you need higher inflation, better economic growth, and higher interest rates. You need the combination of those three, and I don't think we're going to get it. So we've been even weight financials. I don't see us changing that particular rating. But you mentioned sectors, and did you notice today, utilities and telecom, defensive sectors, absolutely at the bottom, and some of the cyclicals hanging in there on top, even though we had a really big down day. It's the sector performance on the day, and granted, it's only one day. It was the opposite of what a lot of people would think.
Dude, even if you stretch it out over the last 3 months, Scott, utilities and consumer staples, I'm looking at the L1 GICS group on the S&P. Utilities, consumer staples are the biggest losers over the last 3 months. The big winners are IT stocks, #1, and then the financials. I wanted to ask you about the IT stocks, because we were talking to Howard Lindzen earlier. He says he sees them breaking out here. He's a big believer in the big tech stocks, even with all of the trouble they're getting, say, from like EU watchdogs and stuff. Do you think that big tech stocks, are ready to rally back to where they were at the beginning of the last decade?
Well, we're overweight technology. I think we're going to continue to be overweight technology. And, Matt, actually, since February the 11th, staples, utilities, and telecom have been the worst performers. So it's even longer than 3 months. But, yes, technology, I think there's a lot of things going on out there driving technology. I think you're going to see more business spending on technology. I think you're going to see more consumer spending on technology. Those things have lagged to some extent. But definitely, when we look ahead over the next 6 to 9 months, we see technology along with industrials, consumer discretionary, and healthcare all as outperformers.
All right, really cool to have you. Your time today, Scott. Really appreciate it. Scott Wren there, Senior Global Equity Strategist at Wells Fargo Investment Institute. Let's bring in now Bloomberg's Oliver Rennick. He has actually brought some charts with him, believe it or not, that give us a little more about today's market moves. So, Ollie, what have you got?
Believe it or not, I do have some charts, but even more so than charts, I have a piece of paper with words on it, which I never usually do except for days where it's really complicated. But today I brought this because if you could put this together as an image, it's like puzzles, pieces fitting together perfectly. Like when you look through the market today, I had to write it down. It was just amazing. I mean, we woke up and we saw bond yields rising around the world. Then we saw bond yields in America doing the exact same thing. We saw Treasury 10-years jumping up to levels we haven't seen since June. Okay, then on the back of that, you look at what's happening sector-wise. You look at the REITs, utilities, consumer staples, the Vanguard dividend ETF. They're all trading 2 standard deviations below their normal, going down. Then you look at what's happening here. This is the exact description of that, where you were just talking with Scott about the underperformance, and he's right. Since February 11th, utilities, the staples, they've done weak. They've been underperforming. What's the most important part of this chart is that bottom part there. Okay,
the negative correlation.
The negative correlation between bond yields and stock price, which means a positive correlation between prices. Now, you're seeing that dip negative, the most negative since April 2015, meaning that we're seeing these two asset classes move in the same direction. And by the way, this is not on a price correlation. This is the percent daily change. So basically, bonds losing, stocks are going to lose too. That's the way it's been for the past couple months. That's a big deal for, as you talked about, risk parity investors. That's a big deal. When you think about why, it's got to be because of all the flows, all the capital that has gone into the bond-sensitive sectors, and that causes them to sell off when rates jump. I think it's a big deal, and the question really is, I guess, what impact those rate-sensitive sectors are going to have. Is it the 2.5% today, and then we move on from it, and the air has been let out from those sectors, or is it something that's going to continue for a while? I think you can make the argument that it could continue for a while because it's not just about the fundamental reason for being in the stocks. They're now also the momentum stocks. They're in all these other categories now, too.
All right, so we focused on bonds. Obviously, they were the catalyst here. Stock market sell-off is something that we've been focused on because the market just closed 40 minutes ago. But you look at the dollar, and yes, it moved higher today, but not by a whole lot. Gold, however, has stayed fairly elevated. Yeah,
it's pretty interesting. You're actually looking at, that's actually a great chart because when you think about the dollar play, this is has a particular kind of relevancy for stocks. Because
this is like a 3-year chart, by the way.
Right, yeah. When you look at what's happening with the dollar, here's the thing. If this is purely a rate move today, and you see the 10-year jump, you think that, okay, there's going to be maybe some sort of equivalent strength in the U.S. dollar. And then when you take that a step further, it's then, okay, maybe the U.S.-based companies, the smaller caps with the domestic earnings stream are going to do better. But they actually didn't today. They sold off quite a bit. So here's the difference between just a rate play and just a rate sort of move today and versus this sort of sentiment. And here's what happens, because when you have the small caps selling off, the Russell 2000 down quite a bit, even more so than the S&P 500, that seems like a sentiment, like a risk-off type of play.
All right, Oliver Rennick, thank you, and thank you for coming with charts. As always, we appreciate it. All right, let's get to First Word News this afternoon. Mark Crumpton has more in our newsroom. Mark?
Scarlet, the United Nations Security Council has scheduled an emergency meeting this afternoon on North Korea's latest nuclear test. Secretary General Ban Ki-moon called the test, quote, unacceptable.
I condemn in the strongest possible terms the underground nuclear test by the Democratic People's Republic of Korea. This is yet another brazen breach of the resolutions of the Security Council.
The council threatened what it calls further significant measures if Kim Jong-un's regime refuses to stop its nuclear and missile tests. The presidential candidates are weighing in on North Korea. Hillary Clinton says the move is, quote, outrageous and unacceptable, and that China needs to increase pressure on North Korea. Donald Trump says the test shows Secretary Clinton's, quote, failures when she was at the State Department. House Speaker Paul Ryan, Minority Leader Nancy Pelosi, and other members of Congress gathered on the steps of the Capitol earlier today to commemorate the 15th anniversary of 9/11. Speaker Ryan said the events of that day should be honored rather than relived. And a programming note, tune in on Sunday for Bloomberg television and radio special coverage of the commemoration ceremony of the 9/11 attacks. It begins at 8:45 a.m. New York time. The UN says the effects of a crippling drought that's been raging across southern Africa, those effects are about to get much worse. The organization's World Food Program expects the number of people relying on food aid to double to 14.1 million by the end of this year. Adequate emergency responses until April of next year will cost more than $600 million, that according to the WFP. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg. Matt?
Mark, thank you very much. Now, coming up on What'd You Miss, we talked today with Vanguard co-founder Jack Bogle about everything you could imagine, but ETFs and robo-advising I thought were very interesting subjects. What he had to say about it next. This is Bloomberg. What'd you miss? The Vanguard 500 Index Fund was born 4 decades ago with some $11 million in assets back in 1976. It seemed like a crazy idea, but today it is Vanguard founder Jack Bogle who is having the last laugh. The fund is now worth more than $3.5 trillion, but indexing has no shortage of critics nonetheless. Scarlet and I spoke with Jack Bogle about that today.
Most of the outlook, people that predict the outlook for the economy are looking at 2 or 3%, at the most 2.5%, actually, for GDP growth. And GDP growth has about a 96%, or I should say corporate earnings have a 96% correlation with GDP growth. I mean, that's a high correlation, and it's hardly surprising. Corporations make money when the economy is good, and they make less money when the economy is growing more slowly. So I just don't see the case for a substantial, if GDP went to 3%, that would be okay, but it would hardly be as sensational, and I think that's going to be a tough smoke to get to 3% GDP.
Jack, you had mentioned that negative interest rates seem to make no sense at all, and I know that you like to invest based on risks that you think you understand. So which of today's risks, whether it's in the U.S., whether it's outside the U.S., in Europe and Japan, do you struggle to get your head around?
Well, the most obvious one is the political situation in the United States of America. I find it deeply worrisome and unpredictable and unfathomable about what might happen come Election Day and what the consequences of that might be. So that's number one. The world economy, number two, is not doing as well as the U.S. economy. And I don't see that Europe and Japan, maybe the emerging markets will do better, but I don't see that Europe and Japan, the biggest components of the world market, are going to be able to grow as fast as we do even. So those are big risks. And then there's always the risk of nuclear war. I don't think it's a very likely risk, but we live in a very fragile world. And somebody's finger on the nuclear button, whether in Moscow or Washington, D.C., is something that I have no ability to predict. I hope sane heads will prevail, but you can't be sure about that. So that's just a handful of them. There are a lot more. Global warming seems to be even accelerating a little bit. It surely is here in Philadelphia today. That's going to be a big problem, a costly problem, and if it continues in this direction. And there are those that feel that it's going to come upon us in a serious way much more quickly than anybody has anticipated.
What about market risks, Jack? I mean, we've seen over your career, surely, so many incredible changes, some of them good, some of them not so much, but ETFs, there's been a huge rise in the use of ETFs. I wonder what you think about that, and the use of computer algorithms to trade and robo-advisors, which I would guess would lead to more, you might think of more as like index investing or like passive investing. How do you view that stuff?
Well, number one, robo-advisors almost universally use index funds, and very often Vanguard index funds. They're not making, in general, big bets on, say, as a market sector or an individual foreign country or something like that. They're basically going with the total market as a part of their stock allocation, and I think that's very wise on their part. The ETF thing is, every day, the SPDR, the Standard & Poor's 500 ETF, is the most widely traded stock in the world. It turns over at 4,000% a year or something like that. And I'm the type of person that thinks a 5% turnover is kind of pushing the envelope. So ETFs are very heavily traded. There are responsible uses of them and perfectly good uses, but I'm afraid the ETF field is dominated by traders, and in the long run, traders are a gift to Wall Street, and by definition, therefore, not a gift to the investors who are doing the trading.
That was Vanguard co-founder Jack Bogle. Coming up, outside of today's sell-off, Volkswagen was a top headline. We'll explain. This is Bloomberg.
I'm Matt Miller. What'd you miss? The latest in the Volkswagen emissions scandal. A veteran VW engineer has pled guilty to conspiring to defraud U.S. regulators and customers. Let's head to Detroit, where Bloomberg's Jamie Butters has the latest. Jamie, thanks for joining us. So is this guy going to go to jail, or is he going to get off easy because he's cooperating with the U.S. government?
Probably more the latter. You know, he pled guilty to conspiracy to defraud the U.S. and commit wire fraud and violate the Clean Air Act, and contains a maximum punishment of 5 years or $250,000 or double whatever the benefit was. So it could be substantial. But I would imagine they'll hold that in reserve while he cooperates and they pursue prosecution of other bigger executives,
Jamie,
higher-ranking executives.
Did this guy think of this all himself and then tell his coworkers, like, shh, don't tell Winterkorn? Or do you think other people at VW maybe knew about it?
Well, yeah, the actual confession was for conspiracy, so there were definitely other people involved. A lot of emails back and forth about, especially about the prosecution or the investigation by the California Air Resources Board and the EPA, and discussing how, you know, they're sharing information and the ARB is not accepting any of our answers, and we need to be really creative. We need to come up with some stuff because they're figuring it out, and they knew they were getting caught.
So, Jamie, tell us a little bit more about this engineer. He's 62 years old. His name is James Liang.
Yes. You know, he spoke a little bit in court. He spoke in English, but they had a German translator there for him in case that would be needed for any technical language. The judge was very careful with him to make sure that he, you know, understood what he was doing, understood the proceedings, understood he did not have to incriminate himself. And, you know, he chose to because they had a lot of evidence that he and these other co-conspirators were guilty. So then that's about all I know.
Are prosecutors, though, Jamie, are they aiming a little higher? I mean, maybe not all the way up to Dr. Winterkorn, or maybe so?
Well, they definitely want to move up. They want to pursue other people. But our understanding is that they won't be able to extradite anyone from Germany because there is a criminal investigation going on there, and as sort of a reciprocal understanding between the two countries. You know, if you're investigating crimes committed by, you know, people in your country, we don't take them and reinvestigate them again. So they may be limited, maybe it can go to the head of Volkswagen of America or that level, but they kind of need to get somebody who's here in the U.S.
All right, so they finally have a name to attach to this emissions cheating scandal. And, of course, the company had previously agreed, Matt, to settlements that may total, what, $16.5 billion.
Pretty high.
Pretty high.
Just for the U.S., that is.
Yeah, and getting, 482,000 of these diesel cars off U.S. roads. We'll continue to monitor all of this. Thank you so much. Bloomberg's Jamie Butters joining us from Detroit.
Coming up, what you need to know to gear up for next week's trading. This is Bloomberg.
Don't miss this. Fed Board Governor Lael Brainerd speaks in Chicago on Monday before Fed officials enter into a period of public silence. And it was the sudden cropping up of her speaking engagement that sparked concerns in the market because she's a noted dove, and people are worried that if she starts sounding more hawkish, that could signal that the Fed is ready to move.
That makes it all the more exciting. On Tuesday, Argentina hosts a business and investment forum. We'll have interviews with President Mauricio Macri, BP CEO Bob Dudley, and much, much more.
And I'll be looking at U.S. retail sales on Thursday. Control Group expected to rise 0.4% for the month of August.
That's all for What You Missed. Thanks for watching.
Have a great weekend. This is Bloomberg.
I'm Donnie Deutsch.
And I'm John Heilman. And with all due respect to Donald Trump, who announced he would reveal his personal health regimen to Dr. Oz, at least you didn't pick the least credible TV doctor known to man.
Almost done, almost done. No. Blah.
I missed you. Oh, I missed you too. Great to see you. All right. In the dugout tonight, big league guests, a political tribute to the Chicago Cubs, and a pinch hitter, Donnie Deutsch. But first, explosive news out of North Korea, the second best Korea. Today, the DPRK said that it conducted an underground nuclear test amid threats of more sanctions from the United States and others. Donald Trump's campaign manager, Kellyanne Conway, said on CBS this morning that North Korea would not dare do such a thing if her tough guy boss were president. And in a statement, the Trump campaign pointed the blame at Hillary Clinton's tenure at the State Department. Quote, Clinton promised to work to end North Korea's nuclear program as Secretary of State, yet the program has only grown in strength and sophistication. Hillary Clinton's North Korean policy is just one more calamitous diplomatic failure from a failed Secretary of State, end quote. On the counterpoint, Hillary Clinton's statement was about the temperament needed to be commander-in-chief. Quote, this is another reminder that America must elect a president who can confront the threats we face with steadiness and strength, end quote. This week, the presidential race has been unusually tuned to themes of national security. Both campaigns have devoted rallies to the topic in recent days and announced endorsements from retired military leaders. But the major event was when the candidates squared off on NBC for that commander-in-chief forum on the Intrepid. So, Donnie, I ask you here on this Friday, no longer a summer Friday, it's sort of a fall for post-summer Friday, post-Labor Day Friday. I ask you, looking back over the week of national security hubbub, who won the week on national security?
Who won the week, we'll find out November 8th. I really think this election was encapsulated by everything that happened this week. And it's a simple hand-to-hand combat. And the calculus is this from Trump's point of view, is that any bad foreign thing that happens, such as that happened today as far as South Korea, North Korea and the nukes, it happened because of weakness and it happened on Hillary Clinton's watch. Right. And I have a strong hand to fix it. If you're Hillary Clinton, the response is, no, 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 that's not a strong hand. That's a scary, unsteady hand, and I have the steady hand.
And an unusually small one.
And usually small one, and she's saving that for the day before election. And that is the calculus we're going back and forth. And the American public, and it's really a left brain, right brain decision, because Trump is actually not offering anything other than, I'm going to huff, I'm going to puff, I'm going to blow your house down. So we're not going to know until November 8th. I don't have the answer to that right now.
It is fascinating to me that both campaigns believe they won this week. I was just over at the Clinton headquarters in Brooklyn, and they think this week was great for them. Most people looked at the commander-in-chief forum and thought that Trump did better. Some people people say that was because the questions were too easy, that she got tougher treatment. But, he was just down at the Value Voters Summit down in Washington just now, speaking, saying, I killed her in this debate. Everybody thinks I'm the stronger commander-in-chief. It's interesting that both campaigns think they have the upper hand here. I do think one thing that has happened this week, though, as a result of all this coverage, is that the focus on substance is starting to move to the fore and away from style, where Trump often wins in terms of his style points. It's now people are starting to actually look at a little bit more of the substantive things. We're going to talk about Putin in a second. I think that plays to Hillary Clinton's favor in the long run.
This is, to that point, this election needs to be an IQ test for the American public. And I don't mean that in an elitist way. Versus,
well, you do a little.
A little bit.
A little.
Bit.
I mean, you can't help but be elitist.
But a man of the people elitist.
Right,
okay?
yeah, right.
Versus just, I'm strong and here's what I'm going to do, versus, no, here are the problems, what are your solutions? And I hope the American public does some digging. I really, really, really do, because the fact that Trump thought he won that, and I think viscerally he did, is the scary thing.
And some of the polling shows that he has a point at this moment. Yes. All right, back in the USSR, Vladimir Putin is making a new addition to his file of nice things that Donald Trump has said about him. Last night, when a phoner between Trump and Larry King was broadcast on the Kremlin-backed English network RT America, Trump seemed to dismiss claims by American intelligence agencies that Russia was probably behind the recent cyber attacks against the Democratic Party.
Unlikely. I think maybe the Democrats are putting that out. Who knows? But I think that it's pretty unlikely. But